Did you know that Americans paid over $1.7 trillion in personal interest payments in 2020? But did you also know that not all of these interest payments are tax deductible? Welcome to the surprising world of loan tax deductions. Now, if you're scratching your head wondering what we mean by tax-deductible interest, let's break it down. When we say an expense is tax-deductible, it means that you can subtract the amount of that expense from your taxable income. So the more deductions you have, the less income you'll be taxed on. Sounds good, right? But here's the catch. Not all interest payments on personal loans and credit card balances are tax-deductible. In fact, in most cases, they won't reduce your taxable income at all. So if you were hoping that your credit card interest could give you a tax break, unfortunately, that's not the case. However, don't despair just yet. There are some exceptions to this rule. Interest on mortgages, student loans, and business loans can often be deducted from your annual taxes, effectively lowering your taxable income. But of course, there are specific criteria that must be met to qualify for these deductions. For instance, mortgage interest is deductible when it's used to buy a primary residence. And in some cases, you can claim a tax credit for mortgage interest through low-income housing programs. That's a significant relief for many homeowners out there. Similarly, if you use a personal loan to buy a vehicle for business purposes, a portion of the interest can be tax deductible, depending on the percentage of business use. These exceptions also apply to investments in S corporations, partnerships, or LLCs. But be warned, these deductions can be complex, so consulting a tax professional is advisable. Now, isn't that a fascinating world of loan tax deductions? We've just scratched the surface and there's so much more to uncover. So stick around to discover which types of loans offer tax benefits and which ones do not. While interest payments on personal loans and credit card balances generally aren't tax deductible, there are some notable exceptions. Let's start with mortgages. The interest you pay on your mortgage can often be deducted from your annual taxes, effectively lowering your taxable income. But there's a catch. This deduction only applies if the mortgage was used to buy your primary residence. Now let's move on to student loans. The interest you pay on student loans is also tax deductible, but only if your modified adjusted gross income, or MAGI, falls below certain thresholds. This deduction can give you a break of up to $2,500 on your taxable income, and it doesn't just apply to loans that you've taken out for yourself. If your spouse or a dependent has taken out a loan, you could qualify for this deduction as well. But remember, the loan must be a qualified student loan, covering eligible higher education expenses at an institution that's eligible for federal financial aid programs. And then there are business loans. If you've taken out a loan for your business, the interest you pay on that loan can often be deducted from your taxes. This could include loans taken out to finance investments in S corporations, partnerships, or LLCs. But be warned, these deductions can get pretty complex. So, if you're going down this road, it's a good idea to consult with a tax professional. But now you might be wondering, what if I used a personal loan or a credit card to cover both personal and business expenses? Can I deduct the interest on those? The answer is maybe. As long as you can clearly separate the business portion of your expenses and itemize them, you might be able to deduct the interest paid on those expenses. But what about personal loans or credit cards used for both personal and business expenses? Let's dive deeper. Using personal loans or credit cards for both personal and business expenses might allow you to deduct the interest paid. Now, isn't that an intriguing concept? Let's delve a little deeper into this. Imagine you're using your personal credit card to purchase supplies for your small business. You can actually deduct the interest paid on those expenses. The trick, however, is in the details. You need to clearly separate the business portion from the personal. This means keeping meticulous records. Every dinner out, every trip to the office supply store, every taxi ride. If it's for your business, it should be recorded and itemized. Now let's consider another scenario. Using a personal loan to buy a vehicle primarily for business use. You might think that the interest on this loan would be completely non-deductible, but hold on. If you can demonstrate that the vehicle is used predominantly for business purposes, a portion of the interest can indeed be tax deductible. The key here, much like with the credit card scenario, is the percentage of business use. The higher the percentage, the larger the potential deduction. Now you might be thinking, well, what about investments? Can I deduct interest from loans used to invest in businesses? The answer is yes, but with a caveat. You can deduct interest from loans used to invest in S corporations, partnerships, or LLCs. However, these deductions can be quite complex. They depend on a multitude of factors, including your personal stake in the business and the nature of the loan itself. So, as you can see, the line between personal and business expenses can sometimes get a little blurry. By being diligent with your records and mindful of your spending, you could potentially turn a portion of your personal loan or credit card interest into tax deductions. But remember, these deductions can be complex. Consulting a tax professional is always a good idea. They can help you navigate the intricate world of tax deductions and ensure you're not missing out on any potential savings. Did you know that interest on student loans is tax deductible if you meet certain requirements? Yes, you heard it right. The interest you pay on your student loans can be deducted from your annual taxes, potentially lowering your taxable income. Let's delve into the specifics, shall we? To qualify for this deduction, your modified adjusted gross income, also known as your MAGI, should fall below specific thresholds. These thresholds are determined annually and can be found on the IRS website or by consulting with a tax professional. The amount of interest you can deduct from your taxable income can be up to $2,500. This deduction applies to loans taken out by you, your spouse, or a dependent, and it's classified as an adjustment to income. It's like a little financial magic trick, where part of your loan interest simply vanishes from your taxable income. But what exactly is a qualified student loan? Well, it is any loan that covers eligible higher education expenses. These expenses include tuition, fees, books, and other essential school supplies. The institution where these expenses are incurred must also be eligible for federal financial aid programs. So, if you're borrowing to finance your education or that of a dependent, a student loan could have tax advantages that personal loans or credit cards don't offer. It's a bit like getting a discount on your education costs, courtesy of the tax system. But remember, every silver lining has a cloud. While student loan interest can be tax deductible, credit card interest doesn't enjoy the same tax benefits. This means that the interest you pay on your credit card debt won't reduce your taxable income regardless of how high it might be. However, credit card interest doesn't enjoy the same tax benefits. Let's unpack that next. As we proceed, remember to always consult with a tax professional to understand how these deductions can benefit you in your specific circumstances. It's always better to be well informed before making any financial decisions. Stay tuned. When it comes to credit card interest, the tax rules are clear. No amount of clever accounting gymnastics can help us here. Credit card interest, unlike mortgage or student loan interest, is not tax deductible under any circumstances. You might be wondering why this is the case. Well, the tax system is designed to encourage certain types of spending and discourage others. It rewards us when we invest in our homes or education by allowing us to deduct the interest paid on these loans. But when it comes to credit card debt, the system is less forgiving. It views credit card spending as consumption, not investment. So if you're looking to leverage your debt for tax benefits, credit cards may not be the best choice. It's a harsh reality, but it's the truth. So are personal loans any different? Let's find out. Personal loans generally don't offer tax benefits, but there's an exception you should know. If you're using a personal loan to cover certain business or education-related expenses, you might be able to enjoy some tax benefits. For instance, if you use a personal loan to purchase a vehicle for business purposes, you may be able to deduct a portion of the interest, depending on how much the vehicle is used for business. Now let's talk about education. If you're using a personal loan to cover tuition, books, or other essentials at an institution eligible for federal financial aid, you could potentially deduct the interest on that loan. But remember, this only applies if your modified adjusted gross income is below a certain threshold. These exceptions aren't simple, and figuring out if you qualify can be complex. So, before taking out a loan, consider the potential tax advantages and consult a tax professional. Understanding the tax implications of your loans can save you money. Yes, it's a mouthful, but it's also a wallet full. You've seen how certain types of loans like mortgages, student loans, and business loans can offer tax deductions. You've also seen how personal loans and credit cards, when used for business or education, can offer similar benefits. But let's face it, tax laws are complex. They're a labyrinth of rules and exceptions, and it can be easy to miss out on potential savings. So what's the solution? Education and consultation. If you're feeling brave, dive into the tax code, do some research, find out how these laws apply to you. If you'd prefer a guide, consult a tax professional. They're experts in navigating this labyrinth and they can help you maximize your savings. Either way, don't leave money on the table. Remember, the more you know, the more you can save. So, start exploring now. Subscribe to Dime Dive.